Okay, so we're going to look at this past exam paper from October 2015. There were two questions, one shorter question for 37 marks and one big question for 63 marks, which is horrific, isn't it, to see such a long question in the exam. I'm going to just go through it quickly so that I can get a feel for what's in each question. Question 1 is for 37 marks. I like to start with the required, as you know. So we go to the required of question 1. The required asks you to prepare a consolidated P&L and other comprehensive income, and then asks you to do just the retained earnings column of the statement of changes in equity for 6 marks. When we look at the question, because the next thing that I like to do is to get a feel for what kind of group structure we've got. We see that we have a company called Dance and a company called Sing and a company called Clap. So Dance, it seems Dance owns Sing and Clap, isn't it, from here. So we've got Dance who owns Sing and Clap. And then it looks like Clap owns a company called Jive, but we haven't been given anything for Jive, so it might be that it's just an investment, carried at fair value. What else do we see on here? We see
this is a demonstration of Wirecast.
Capitals, dividends paid. I see that the one company has an accumulated loss. See what they say here. Dance acquired control of Sing in 2012, and they impaired the goodwill. Then in the current year, it looks like this is the current year 14. Is that right or not?
This is a demonstration of Wirecast.
December 14. So that was in prior years. Then this is current year, beginning of year. This one, and this one, we acquired a 40% interest in Clap and its significant influence. So Clap is an associate with an accumulated loss. Remember what we do with associates and losses. We limit the loss, isn't it? I don't think we actually practiced an example of that. I think I showed you one, but I don't think we actually practiced one. So if we just go back to my picture.
This is a demonstration of Wirecast.
This one is a sub. This one here is an associate. Okay, let's see if they say anything about those investments in the other one. Clap acquired a 5% interest in Jive. So it's just an investment, isn't it? But it was long ago, so on acquisition there would have been that investment and perhaps a mark-to-market. Then Dance sold a machine to Sing and Clap sold inventory to Dance. They measure equity investments at fair value through OCI. You may assume cost is equal to fair value unless otherwise indicated. They account for investments in associates at fair value. They don't say anything about NCI. Or did they say it at the top? Maybe they said it at the top. We leave it there. So it's a basic consolidation. Do you agree with a subsidiary and an associate and intercompany transactions? The approach is to set up this P&L from the trial balance and to set up this retained earnings column also from the trial balance, and then to start your workings. And then basically the first thing as you get to the trial balance is to open your bracket. So what we know is we have a subsidiary. The subsidiary is Sing, so it will be Dance plus Sing, and then there'll be a line for share of profit in associate, which will be Clap, or loss of associate, depending if there was a loss. Remember, we do recognize losses in associates up to the point where our investment becomes nil. Then after that, we don't account for losses until they start to reverse again. Then we wait for it to catch up, and then we start to recognize profits. Question 2, let's just have a look at question 2 to see if it's one that we will be able to do or not. Because we've got those questions, those items that they've left out. So if I look at the required of question 2, I'm sure it's going to be like journals and
This
financial
is a
position
demonstration of
and maybe a bit of
Wirecast.
cash flows. Let's just have a look. 4 required. Discuss whether Jamie has control in terms of IFRS 3. So definition of control and then application, isn't it? So discuss whether they have control in terms of IFRS 3 for 5 marks. We're going into the definition and application and conclusion. Then journal entries to account for the investment in Heston.
This is a demonstration of Wirecast.
I would guess at this stage that Heston's a joint op. You know, I said to you they like to do the joint op things. And then assume that Jamie controls Gordon and that Jamie has a 45% interest in Gordon. Prepare the asset section of the statement of financial position and the NCI column of the statement of changes in equity. So statement of financial position, asset section only, and then
this is a demonstration of Wirecast.
NCI column in statement of consolidated statement of changes in equity. So it looks like it's a doable one. Let's just see if there's any changes in ownership or significant changes in ownership. We look here, question 2. I have no verticals, so that's good. Jamie has an investment in Heston and an investment in Gordon. We carry on looking. I think what lands up being is that Gordon lands up being a subsidiary. We acquired 45% of the shares in Gordon for cash consideration. They had retained earnings, the carrying amounts of assets and liabilities. There was no intention to sell the building. Since 1 January, we had 45% of the votes. The others were held by other people in terms of a contractual arrangement. So here's the story that's going to tell us whether we have control or not. But I think the conclusion is that we do have control. For part B, they say assume you then have control. Then for Heston, we acquired a 50% share in Heston. It looks like it's in the current year. Is our year end also December there? June 14. Okay, so June 14, April, May, June, 3 months. This one we've only had for 3 months. We acquired a 50% interest in a new entity. It is a joint operation, yeah, as I thought. Okay, journals for the joint op. The contract specifies. So no changes in equity actually in this paper. Maybe they had. No, they definitely last semester we still taught all the changes in equity. It looks like there's no change, eh? There's nothing after that. Let me just see down here what it says. Investment in Gordon, investment in equity instruments, invest in the records of Gordon. Some mark-to-markets. Okay. So it looks like we will be able to do both, isn't it? Question 1, a subsidiary and an associate. Question 2, a subsidiary and a joint operation. Joint operations, remember, is the proportionate, where we add the piece. But we're only going to add it for 3, but it's a balance sheet, so we'll add it the whole amount. We don't apportion balance sheets. But we're going to start with this question 1. I'm going to work in Excel while you guys work. We're going to start with setting up a format for the P&L and that retained earnings statement of changes in equity. Then we're going to do some workings and plug numbers in. See how we go. Sometimes what you see when you see their solutions is you see these all done like in a separate calc. Okay? But we're going to try and do as little calcs as much as on there as possible.
This is a demonstration
it's not the nicest way to see it if you're trying to understand what's been done, but in terms of putting it down as a solution, the examiner is just going to look for a number and say, okay, yeah, there's that. They don't have the time to try and understand what you did or where you went wrong. Okay, let's have a look at the calcs first. We start with the acquisition of Sing, which was quite a while ago. Goodwill of 25,500. Yes? There was no adjustment or anything there. And the goodwill was impaired. They said to you it was impaired in 2012. So it must have just retained earnings. Yeah? it must adjust retained earnings. And NCI is measured at percentage NAV, so they don't get any of the goodwill. They also won't get any of the goodwill impairment. If NCI was measured at fair value, they would get goodwill and they would get goodwill impairment. But this way they don't get either. Then the associate was bought at the beginning of the year. There were some adjustments on the associate. I just put them in straight after tax, but I mean on your, when I do it in paper, I put the whole thing in and then I put the tax, I take the tax off. So here we landed up with fair value of 394,660. I took the share capital, the retained earnings. I made a mistake when I was looking at the thing initially. I thought it was maybe the associate that had the loss, but it wasn't. It was the subsidiary. So associate, capital, retained earnings. Then we wrote down inventories and we wrote down receivables after tax, giving you that number. We bought 40%. We paid 150. We had bargain. Now, remember, this was bought at beginning of year. These are current adjustments, these two. Let me just put a... Okay, so these two here are current adjustments. Yeah, these two current adjustments. So what happens is that they reverse immediately, isn't it? They reverse immediately. So both of those and this bargain are going to go against share of profit in associate. Yeah. How do they go against share of profit in associate? Think about what you're doing. On AC, you are crediting the inventory and crediting the payable to make it smaller. But those payables and inventories are not on hand at year end anymore, because it's now a year later. So you're going to have to debit them to get rid of them. And when you debit, what you're going to credit is you're going to credit this share of profit in associate. And then this is a bargain, so that's also a credit to share of profit in associate. Yeah? Okay, so the since acquisition impact of on acquisition adjustments. Those ones are always tricky. You always have to think about them. But remember, current ones reverse immediately. So because this was an acquisition in the current year, they reverse straight to profit. What else have we got on here? No, let's go back to Excel. Am I in Excel? Am I not in Excel? I think I'm not. Okay, go back to Excel. Then we had a sale of machinery. It's downstream from the sub, right? That helps you to just know, am I adjusting NCI or not adjusting NCI? When it's downstream, I never adjust NCI. The profit's in the parent. It was downstream from the sub. It was in current year. So the profit of 25 is sitting in other income. It must reverse. And the tax is sitting in tax. It must reverse. And then I adjust depreciation for the current year only because it was current year for 9 months. Is that what you got as well from the 1st of April? And I adjust depreciation for 9 months over 5 years, 9 of 60. So there's my calculation. 9 months of the 60 months times the 25 gives me a depreciation adjustment of 3750. I must adjust depreciation and I must adjust tax. Then there's a sale of inventory, Calc 4. And you must get used to, as you do the calcs, go put the numbers in. Because what happens when you put them in later, then you forget. Like I forgot to put that dividend in because I thought, I'll do it later, and then I never did it. All right, so then we have the inventory. The inventory was sold upstream from the associate.
This is a demonstration
at beginning of year, there was nothing. So there's only something at end of year. At end of year, there's inventory on hand of 18. Remember, when it's upstream, there's also no adjustment to sales and cost of sales. If it was downstream, there would be an adjustment to sales and cost of sales, but it would never be the 80. It would only be the 18 times 40%. Okay, but in this case, it's upstream, so we don't adjust sales, cost of sales. So it's 18 end of year. Cost of sales is 65%, profit 35. It was based on selling price. I don't know, we get confused with which one to use when and what it means, but basically if it's selling price, it's easy. You just take the number and times it by 35. So that times 35 gave you the profit of 6.3. tax is 28%, giving me a net of 4536, but I only take 40%, and it goes to share of profit in associates. Going to make share of profit in associates smaller, because we're going to make inventory smaller as well. And then so we're going to credit inventory and debit share of profit in associates. Then I did some retained. Okay, so let's just look first at all of that and how it all flows through. So if I go up here, revenue is just parent plus sub, cost of sales is parent plus sub. Other income, parent plus sub, and then I adjust for the impairment of the, no, what am I adjusting for? For the profit on sale of the machine, and I'm adjusting for the dividend received by the subsidiary of the associate, from the associate. No, by the parent from the associate.
Of Wirecast.
Other expenses is just parent plus sub, and there I adjust the depreciation. Finance charges is parent plus sub. I meant to check. There were no loans, intercompany loans on the face of the, okay. Just be careful with that. If there are intercompany loans on the face, then sometimes they don't tell you in the story that there's intercompany interest that needs to be reversed. I meant to check that. When I was doing it, I thought I must go check that, and then I didn't check. All right, but there were none. And then share of profit in associates. Share of profit in associates is all the numbers for the associate, times by 40%. And then I put in all my adjustments. So I had the adjustment for inventory, it was going to make it bigger, 40%. I had the adjustment for receivables, it was going to make it bigger, 40%. I had the adjustment for the bargain. It's already 40%, because if you look at the way the calc is, it's already 40%. And then I have the adjustment for the profit on sale of inventory, which is a minus. The other's all plus, this one's a minus. And I'll end up with share of profit in associates of 67,826. Tax, parent plus sub, and then there were two adjustments up here that had tax implications. The one was the 25, the other one was the depreciation. Remember, the inventory is already after tax, that 1814, because the tax and the cost of sales lands up in the one number, which is share of profit in associate. And so I'll end up with profits of 329,758. What I have to do is work out NCI now. NCI was straightforward here. There were no adjustments to NCI. They didn't get any impairment share. There were no upstream transactions from the subsidiary. What else would cause NCI adjustments? Writing off goodwill, upstream transactions from a subsidiary. That's it, basically, isn't it? So we had none of that. So it's just all the sub numbers times 30, and they get 21,773, and the parent gets the balance. It's just a balancing figure. I've written there balancing. There was no OCI. I don't know if in an exam, if there was none, if I would just put a 0. I probably would, but I don't know if I would say revalue. I would just say OCI 0 and leave it like that. And then, so I can actually do that here, is get rid of all these extra lines, because they're just a waste of time. I don't know if it's going to cause a problem. No, it won't. Like that. So parent share of profit and parent share of profit and total profit and OCI is the same. Then statement of changes in equity. So statement of changes in equity, I did a calc at the bottom for retained earnings. Retained earnings for the parent is a straightforward number. It's just the number for the parent. Yeah. And I had put a thing on here to me. It's not 618. It's 618, 844, 844, not 884. Okay. So for the parent, it's just the parent's retained earnings. If there were any downstream transactions from prior years, those would be affected there, isn't it? We would adjust retained earnings. So any prior year intercompany transactions, machinery, inventory, that are downstream affect the parent's retained earnings. That would be adjustments there. Otherwise, I don't know. The other thing that you could have done, I put the impairment into Singh's numbers, but you could have put it into the parent. Because I suppose the parent is paying all of it, but it doesn't really matter where it lands up, I suppose. Then for Singh, we had a loss at end of year, at beginning of year at 88. At beginning we had 65, so it's the movement, that's the loss for the current year. It's only my share, because the NCI will get their share of the loss. And then the 25.5 is the write-off of the impairment of the goodwill, the impairment of the goodwill. So those are the numbers I get, 580,494. Then the face of your statement of changes in equity, if you've got the 58494, where is it? Up here.
This is a
Then
demonstration
it's just
of Wirecast.
profit that comes from here, this profit number, and then it's the dividend that they paid, the parent paid of 50, giving you a balance at end. How did you find that? Doable? Associates? Was okay? All right, good. Okay. So, third year, you guys, when did you do 2602? Last year, a year ago.
This is a demonstration of Wirecast.
But you still do remember it, it looks like. Yeah. So that's groups. It is a section that's hard. It's like a hard section of work. But, when it clicks, And even honors level students, some of them will say, no, groups is their favorite. Because it's always the same flow of things and how things go, isn't it? And they find that if you practice, I had students that would say that practice a groups question every day or every other day. If you practice that much, you can then do groups, no problem. Okay, so that's the first one. Second one then. Second one had these two requireds. I think we're going to start with required A. Discuss whether Jamie has control over Gordon in terms of IFRS 3 business combinations.
This is a demonstration of Wirecast.
Page 14 of the study guide. An investor controls an investee when it has all three of the following. Power. It has power when it has existing rights that give it the ability to direct the relevant activities. It has exposure to variable returns through their relationship, and it has the ability to use that power to affect the amount of returns that will be exposed. Okay, so those are the three that you have to try and apply. Have a look at what they say about what our investment in Jamie, yeah, and then see if you can conclude that. Remember, the format is facts, theory, which is this, apply bit by bit by bit,
this is
conclude.
A demonstration of Wirecast.
Okay, I'll just put this. So if we look at the theory, to have control, we have to have the right to variable returns.
This is a demonstration of Wirecast.
We have to have the ability to affect the returns, and we have to have the power through power, through power over investee.
This is a demonstration of Wirecast.
Those are the three pieces, right? So we look at this question. So that's what you would say. You'd start with a fact. Rocky, it's not Rocky. I don't know why I've got Rocky on the mind. It's a completely different question. Gordon, is it? Oh, you know what they are, the chefs. Did you realize? Gordon Ramsay and Jamie Oliver. So Gordon, it says Gordon acquired 45% of the ordinary shares in Jamie. Jamie acquired in Gordon. So do we have some power over the investee? We have 45%. It's not control. Do you agree? 45%, you can't pass resolutions, you don't have control with 45%. Do you have the right to variable returns? Yes. You've got a 45% share, and so therefore you get dividends.
This is a demonstration of Wirecast.
Okay, so let's see what else they say. Since 1 January, Jamie held 45% of the votes. 45% of the votes, 45% of the shares. It's important to look at that because shares and votes is not always the same. So you can have shares, but they do these classes of shares, A, B, C. So some shares have more votes, some shares have less votes. So it's important to distinguish that we have 45% of the shares, so we get 45% of the dividends, and we also have 45% of the votes, shareholder votes. Because of holding 45% of the shares, okay? But 45% of the shareholder votes doesn't give us control because there's George who owns the other 45%, and who's George? George Locatelli. And Gary who owns the other 10. So there's George and Gary who own... Gary, there's a chef called Gary as well. There's a George and a Gary that own the rest. But they say, in terms of a contractual arrangement, Jamie can appoint or remove 3 of the 5 directors. Contractual agreement, 3 of the 5 directors. Okay, so do you agree that that's power? So our power of the investee is that we can appoint 3 of the 5 directors. Who makes decisions in the company?
This is a demonstration
made by directors, isn't it? And so therefore, can the directors make decisions to affect the returns of the company? Yes. Do we have control of that? Yes. Do we have the ability to affect that? Yes, we do, because we appoint 3 of the 5 directors. It says there's no change to the contractual agreement and the relevant activities were directed by the board. So it looks like we do have control, isn't it? So then you would conclude that you do have control. So essentially it's that. You can see at honors level the questions get more advanced and more complicated. I don't know how many marks in total. What does it say? 11 for that one. 10. Yeah. So you can see it gets more complicated. Those 2 examples, I think, are about options, because that could be another way to phrase this, is to say you currently own 45%, but you've got the option to buy another 15. That would take you to 60, isn't it? Then it's all dependent on whether you can exercise that option or not. Because if you can, then you've got power, hey? Because anytime then you want to pass a resolution or stop a resolution or whatever, you can quickly exercise your shares. If you can't exercise them, if they are dependent on some condition that you have no control over, then you don't have power, isn't it? And I think that's the discussions they go into over there. Okay? All right. So 5 marks. You wouldn't have lost sleep if you couldn't do it either, isn't it? All right. So the next question is then about joint operation. A joint operation Heston. They want you to do the journal entries. Remember the journal entries that we do for a joint op. We first bring in journal entry whole TB at percentage. Yeah? Whole TB at your end at the percentage. Okay, that's your first journal. Your second journal is your on-AC journal. There's no, for the on-AC journal, there is no on-acquisition adjustment, no NCI, it's percentage only.
This is a demonstration of Wirecast.
And there's no NCI, but there might be goodwill or bargain, right? Then, journal 3 is intercompanies. Remember, with intercompanies, percentage only, but otherwise the same as a subsidiary. Do you agree? Intercompanies, dividends being one that will almost always be there. Your loans, your management fees or interest, and then your ones with profit, inventory, machinery, etc., etc. Yeah? Okay. How many marks? 18 marks, is it for that? Oh, up there. Such a nice, easy, give me the marks. Thank you. I'll take it. Do you agree? All right. So hopefully they do like to ask us joint ops journals. So let's hope we have one in our exam too. Okay, let's do that. Okay. So bring in, I had to go back and read again because I didn't read carefully. We bought it at incorporation. There was no retained earnings, no profit, no nothing. The business was just starting. So then there was no retained earnings number, but then I did check that I balanced, so then I knew that I had everything in, because they gave it to you a bit
This
funny.
is a
So we
demonstration
bring
of
in
Wirecast.
half of inventory, half of receivables, half of cash, half of the liability, half of the share capital. No retained earnings, because it's first year, retained earnings would be beginning of year. Then I bring in revenue, cost of sales, OPEX, tax, and the dividend that was paid, and then I checked that I balanced, because it was given in lots of bits. Then I do the ONAC. ONAC, always that percentage, 50%. Reverse that share capital, reverse the investment. The investment was still at
This
cost. I
is
did
a
check that.
demonstration
If the
of
investment had been fair
Wirecast.
valued, you would have had to reverse the fair value adjustment. So investment was still at cost, so that reversed, and then goodwill of 3 is what we land up with. Then we have intercompany transaction for inventory. We reverse the sale and cost of sale, only our half, not the other half. And then we reverse the profit on the inventory and the tax on the inventory at year end. Did you agree with that number? It was 30,000, 25%, 35, something like that. It was also on selling price, 20%.
This
Yeah.
is a
It's funny because
demonstration
in
of
all the questions that
Wirecast.
we practice, they work on markup on cost. And then now we've done 2 in the past exam that work on selling price. And if you don't read carefully, you can get it wrong, isn't it? So do you agree with the 3? And the 840 then being the tax. Whatever happens, the tax is the opposite. So debit P&L, credit P&L for tax, debit SFP, credit SFP for tax. Then there was management fee, 30,000 Rand, 10,000 Rand a month, April, May, June. Half is what I reversed, and then there was the dividend, which I had brought in the 55.
This is a demonstration of Wirecast.
22.5 marks. Nice marks, eh? So we can only hope that we get something like that. Joint ops I like joint ops. It's like one of the easiest things to consolidate. No NCI to worry about. You bring in everything, you just bring in your share. It's very much nicer than subsidiaries because of NCI, much nicer than associates. So because associates is just the one line. We always have to try and think, where does the stuff go? Right, so we'll pick up next week. We'll carry on.
This is a
I want to
demonstration
talk about
of
when you want to do the
Wirecast.
catch-up. So we have 2 catch-ups to do. One for the 21st of March, one for the 28th of March, the 2 public holidays. So I don't know when you want to do them. My availability is, so it's 4 hours, so you have to make up. I don't know, if you really wanted to, we could do extra long lectures on a Monday, but I don't know what the rest of your day looks like. For me, it's not ideal.
This is a demonstration of Wirecast.
Thursday mornings from 10 or Friday mornings. You have auditing at 10. That auditing too. From half past 10 to 10, which is the same thing that other girl had. Hey. So what do you think? Do you want to come on a Friday, or you want to rather make the Mondays longer?
Fridays we off, so
This is a demonstration of Wirecast.
The 4 hours in one shot on a Friday, or do you want to do? And
then we have to come 2 Fridays, and I have to do those other modules of mine.
4 hours is fine.
Okay, 4 hours.
okay, not this Friday because I'm going to take her to the doctor. Next Friday? What's next Friday's date? The 22nd?
Should be.
Yeah.
Okay.
What time?
Whatever time suits you guys.
This
Maybe
is a
9 till 1.
demonstration of
Do
Wirecast.
that, or you want to do 8 till 12?
8 till 12.
Huh?
8 till 12.
Really? You'd rather be at 8? 8 till 12 it is. So Friday, the 22nd, eh?
Yeah. And then we have.
But you know, yeah. Let me see. Friday, 22, 8 till 12. If you feel like you don't need to come, then I don't know, you don't come.
This is a demonstration of Wirecast.
The reason we have so many revision lectures is because they shorten the syllabus, because we would only otherwise be not even finishing today, right? Today we would still be doing rights issues, and then next week we would be doing cash flows, and only then would we be going into revision. But because of that we're going into revision early. So Friday the 22nd, right?
So we're not doing cash flows
No,
at all.
at all.
This is
They
a
said it was
demonstration
because
of
of the late
Wirecast.
registrations, but I don't know because none of the other modules have done that.
That's
It would
weird.
be nice if all the modules did it,
Yeah.
isn't it? But the others have not.
Thank you.
Thank you.
Okay then.
This is a demonstration of Wirecast. This is a demonstration of Wirecast.
What did we say about catch-up lectures? We were going to do it closer to the end of May,
Yeah, I said close to the end of May, but you said
and
the
we're going to
others.
do 4 hours. Hey, we were going to agree today.
This is a demonstration of Wirecast.
Close to May, is it going to be at the end of May?
Oh, your exam is only in June, isn't it?
Yes, and
So I don't know. Whenever you guys want to do it, I mean, we can do it now if you want.
no, a week before is fine.
So let's see what the